Hey, what is up guys, welcome back to ProTraderPath. I'm back with another video, and in today's video I'll be talking about the sell side curve of a market maker sell model. And before I go to the main part, let me just recap a little from the previous lesson. So in the previous lesson we talked about the buy side of the curve on a market maker sell model, which in the higher time frame it looks like a retracement or a liquidity raid while retracing to a higher time frame point of interest. In this case we are talking about a fair value gap, so the retracement is actually grabbing the liquidity from its nearest level. At the same time it's rebalancing the imbalance on the lower time frame. This retracement to the higher time frame point of interest on the higher time frame looks like this on the lower time frame. Okay, so once market rebalances the imbalance on the higher time frame, market will then go for the sell side liquidity or deliver for the sell side on a market maker sell model. And of course don't forget that the higher time frame bearish bias has to be there while you are looking for a market maker sell model on the market, and vice versa for the market maker buy model. So the higher time frame drawn liquidity or the bias has to be bullish in terms of looking for a market maker buy model. Now in this area, when market filled up the higher time frame imbalance or the fair value gap, it will then deliver for the sell side and go to the initial consolidation liquidity low to grab the sell side liquidity. So how does that look in terms of the candle? So this sell side delivery will look on the lower time frame something like this. Okay, so I will be explaining every single step. So without any further ado, let's go to that part. So once price leaves its initial consolidation and in a stage of delivering for the buy side of the curve on a market maker sell model, once it reaches to the higher time frame point of interest, we then have a reversal. The reversal is called smart money reversal or SMR. What is a smart money reversal? A smart money reversal is a change in state of delivery. I will explain it in a bit. What does that mean is, algorithm from a buy program starts to deliver on a sell program or turns the buy program into a sell program. For a market maker buy model, it's the vice versa. So from a sell program, it then changes its state in a buy program. So a change in state of delivery is what causes or what confirms the smart money reversal. Now let's talk about the change in state of delivery or the smart money reversal. In previous lesson I have talked about two types of smart money reversal. Type 1 reversal, where market takes its recent swing high, or along with this high it takes some other liquidities, it reaches to the higher time frame point of interest, and then it gives you a change in state of delivery or market structure shift or break in market structure below the recent swing low. This high, low, higher high, and then the delivery on the sell side that causes the break in market structure or market structure shift, that is the type 1 and the high probability and highly recommended one. The type 2 is market fails to take the liquidity, it reaches to the higher time frame point of interest, so it creates a lower high and then it breaks below the recent swing low and give you the break in market structure shift. This one is a low probability comparing to this one, but once we have a change in state of delivery or once we have a break in market structure, we can look for few other things to actually give us extra confluence or confirmation. When we are using the type 2, we want to see that the correlated asset, for example let's say this is NQ and this is ES, so the correlated asset has created this type of reversal where it has created a high, low, higher high, and the other asset correlated, that one has created a high, low, lower high, lower low. Okay, that way. So when I have this, we call this the SMT divergence. So we look for SMT on the correlated asset in this way. A correlated asset, one will create a higher high and then it will give you the break in market structure or the market structure shift, and the other correlated asset will give you a lower high with a break in market structure. So the type 2 we can use when there is a SMT divergence, then it will give us the extra confluence for an inversely correlated asset, for example DXY and Euro or GBP USD pairs like that. We want to see that one asset is creating higher highs and another asset is creating lower lows. So that way we can utilize the inversely correlated assets, or as I said, the type 1 and the type 2, we can look into the correlated asset. So that will give us some extra confirmation. I hope that part is clear. In this part of the video, we are going to focus on the type 1. It is the same for the type 2 as well, just you are looking for that SMT on the correlated asset, or inversely correlated asset you are looking the opposite way, as I explained earlier. So let's go inside and talk deeply about the type 1 reversal. So in the candle form, it will look something like this. Price will go higher, grab the liquidity from its recent swing high, and it will reach to the higher time frame point of interest, then it deliver for the sell side, and when price goes below that swing low, recent swing low, we then have a break in market structure or a market structure shift. Now this market structure shift is confirmed only if there is a fair value gap available in this expansion leg. If there is no fair value, then this break in market structure is not valid. The last up close candle that was responsible for taking the buy side liquidity, when price runs below or goes below that opening price, it is confirmed as your order block, and at the same time that will confirm the change in state of delivery. So the change in state of delivery and the order block is also confirmed when you have that fair value gap available in that range. Now if there is more than one candle that took the liquidity and ran into the higher time frame point of interest, in that case also you're looking into the candle that is responsible for taking the liquidity. When price comes and closes below the opening price of that candle that is responsible for taking the liquidity, that candle will be considered as your order block, and that will also validate your change in state of delivery as long as there is a fair value gap available in that distribution leg. I hope that part is clear. Now let's talk about the sell side of the curve. After market ran into the higher time frame point of interest, taking the liquidity from a recent swing high or a previous swing high from the left, and ran into that higher time frame point of interest, we can then look for a possible reversal. This move before the retracement from the swing low to the swing high, this move is called the manipulation swing. This move tricks buyers into more long positions so that smart money can later on run their sell side liquidity as well, the sell stops. And in my previous video I talked about this move, that usually this move goes in a very explosive way. It runs very quick towards that higher time frame point of interest so that it can trick people into more long positions. From the retracement low to the higher time frame point of interest, the high, we call this as the manipulation leg of the smart money reversal. During this, the high will usually form a intermediate term high with a short term high on the left and a short term high on the right. So that becomes the intermediate term high. Once the smart money reversal is confirmed, which I already shared with the candle example as well, we can now anticipate how far market can go in terms of our liquidity target or our sell short target to take our profit. The first target for us will be the initial consolidation low, the liquidity below that. But if we have a higher time frame point of interest sitting below those areas, we can now have something called pip range. We can grid the pip range from 5 pip, 10 pip, 15 pip and 20 pip. If a high time frame point of interest is aligning or is at a close proximity to any of those pip range, that will be a high probability target for you to look for. At the same time, as I said on the previous video, that if there is a big figure sitting inside of your higher time frame point of interest, such as 00 or 500 or 1100, things like that, if a big figure is sitting right there, we can look for somewhat between 30, 40 or 50 pip range for the market to reach. Okay, so that being said, now to give us extra confluence, once we identify the high time frame point of interest that's sitting within our pip range, and we identify the manipulation leg high or the intermediate term high, we can now draw a fib from that high to the manipulation leg low and see if a standard deviation is aligning at a close proximity within that high time frame point of interest. In this case, it's aligning perfectly, but you don't really need to be that perfect. It can be close proximate, so it can be closely above that area or inside of that high time frame point of interest. But as long as it is aligning at a close proximity, this is giving you a higher confirmation or confluence that you are actually correct about the possible area where market will reach for. To give you more added confluence, once the smart money reversal happens, we can take the breaker swing, which is this swing where we'll have a breaker block as well. I will talk about it later. However, you can take that swing high to swing low and see if a standard deviation from this projection is also at a close proximity to that level or not, to give you more added confluence. This breaker swing is a very important projection level that usually we all look for, or we all actually project from. So this one and this one, these two will give you that confluence. Once you figure out where market is possibly reaching or going to reach, you can now grid your projection just like we did on the buy side of the curve. Once you grid this, you already know what to look for around the gridded range. However, the first stage of distribution will most likely to occur around that 25% of the range, and around that area will most likely to see a breakaway gap, which will be either completely unfilled or partially filled. I will talk about the different types of gap in the later video. However, for now, around that 25% area, you are looking into the possible first stage of the distribution and expecting a breakaway gap or a unfilled fair value gap. Around the 50% level, you will most likely to see a measuring gap, a fair value gap that will be either completely unfilled or partially filled with portion open. Once you find that measuring gap, it gives you extra confluence that we are right about our calibrated area or the projected area where price will possibly go. And also, as I said on the buy side of the curve, that when you get that measuring gap, it will also confirm that you are already 50%, you have already received the 50% delivery of a market maker sell model. So you have another 50% to go, things like that. Around the 75% level, we will most likely have our second stage of distribution or the redistribution leg, and this area we will most likely get our silver bullet. Now in the next lesson, I will talk about why and how the silver bullet forms and how we can anticipate into a trade using the silver bullet method. Okay, we can reverse all of this for the buy side of the market maker buy model. So we now have our manipulation leg, which has run the buy side liquidity and reached to our higher time frame point of interest, or the level that we anticipated during the buy side of the curve. And we now looking into a change in state of delivery confirmed by a displacement as a fair value gap. So this change in state of delivery, it will look something like this, and price now initiated the sell program. So once the change in state of delivery is confirmed, which is again, it closes below the opening price of the last up close candle that is responsible for taking the buy side liquidity, or that has run the buy side liquidity. We now have a fair value gap or the displacement that is confirming the order block and the change in state of delivery. This is the area where we can expect price to reach for, and this is where we have the low risk entry or our first entry. Price can often revisit that opening price of that order block and starts to sell off from there. On the lower time frame, we usually have a fair value gap around that area as well. However, price can go up to the min threshold or even above the min threshold, but we don't want to see a body is closing above the min threshold or price is violating the min threshold with a body close. So we want to see the respect. It's better if price doesn't even reach there and starts to sell off with new displacements or fair value gaps. Now, for this type of entry, time will be playing the most important role, and in a later lesson I will talk about the time and discuss in depth, because it's a elaborate or a huge area to talk about, because the time that we are choosing or we are trading, it will differ person to person. So within that lesson, a lot of the confusions will be cleared. For now, your main focus is to look for the projections, look for the grid levels and what you are looking into in terms of your homework. By the same time, if possible, the entries that I'm actually trying to give you here, you can try on a paper trade or a demo account for those sort of entries. But as I said, it's only for the education purpose or educational reason only. Okay, so I hope you guys will bear with me, stay with me until I'm done with all the lessons. After the change in state of delivery or the first entry pattern, we then have the break in market structure or market structure shift. So when price runs below the sell side liquidity of the second stage of reaccumulation or the reaccumulation stage, we can confirm our market structure shift as long as we get that fair value gap. Now, we don't really need to see a body closing below the swing low or the reaccumulation swing low. We don't really need a body close. A wick can also confirm that as long as the fair value gap is present. However, a body closing below is giving us more confluence. Now, often what we as a trader do is we zoom in so much into the lower time frame. For example, we zoom into a 1 minute time frame and we look for some sort of internal structures for a market structure shift, but that can sometimes cause the false breakout and result into losing trades. We sometimes need to move forward and backward into the different time frames in terms of intermediate term or higher time frame, so that we can know where exactly we are currently sitting in terms of the manipulation leg or the distribution leg. I hope that part is clear. If not, it will be clear on the later stages as well. The highest probability of break of a structure is when market goes below the final stage or the second stage. Again, there can be multiple stages, so in this case I'm showing 2 stages. There can be 3-4 stages as well, but the highest probability will be when price goes below that final stage, that manipulation leg or the reaccumulation leg swing low. Below that, that is your highest probability market structure shift. So yes, it will work if you look into the intermediate terms, but the highest probability will always be that low. Okay, and again the fair value gap will confirm the valid break of a structure or market structure shift. In this area, we'll have our first stage of distribution. Price will return to the fair value gap inside of a breaker. We'll have the last down close candle with the lowest body or series of down close candle. If there is multiple down close candles together, from that lowest down close body, the low to that high is our breaker block, and inside of that breaker block, if it is a high probability breaker block, you will most often see a fair value gap aligning with your breaker block. So price will run and mitigate inside of that breaker, and we then have a second break of a structure below that recent swing low, and price will continue lower for that sell side liquidity resting below the first stage of accumulation. Now this setup is also known as the unicorn model. So as you can see, this is the unicorn's horn that you can see over there. Price will get inside, price will continue lower. So I'm not a huge fan of the unicorn model. However, the 2022 mentorship is also based on that. So liquidity graph market structure shift, the unicorn model as well. However, as I said, just to keep things simple, you look for a valid market structure shift with that fair value gap, and if that fair value gap aligns with your breaker block, price will continue inside of that fair value, mitigate the breaker, and it will give you a second break of a structure for a continuation lower to the first stage of sell side liquidity, or to the liquidity that's sitting below the first stage of the accumulation phase. Once we run below the sell side liquidity of the first stage of accumulation, price will then retrace or return into a fair value gap inside of a distribution block, where it will either rebalance some imbalance for a continuation lower on a market maker sell model, or it will grab some short-term liquidities that we also know as the inducement. It will grab some short-term liquidity, run into that, buy stops, and then it will deliver the second stage of the distribution. Now a distribution block, or the D block, is the last down close candle or candles. Those are like, if there are multiple like this or this, the last down close candles inside of your first stage of accumulation, which is this side. And again, there can be multiple stages, but the concept remains the same. The last down close candle or candles are your distribution block. In a later video, I'll try to explain those things with the gaps, different types of gaps, so that it can be more clear. However, price will run into the distribution block. If a fair value gap aligns with that distribution block, that will be a very good area to look for another entry for the continuation below that initial consolidation sell side and our projected terminus, which we marked as with our P prints and the high time frame point of interest. So this area we will be having another fair value gap, or as I said, short-term highs as our sell buy side liquidity. Market will grab that buy side liquidity before continuing lower. So if we are looking for an entry around that area, we can use our distribution block to put our stop loss. Our stop loss we can put above, a little above that distribution area. Price will most likely return from the lower part of the discount area. However, price can go completely fill up or reach to the upper portion of the distribution block, but it will be still valid. All we are using this is as our added confluence for that fair value gap that we have. Okay, so after that retracement into the imbalance or that buy stop or inside of that distribution block or D block, market will continue lower and deliver for our initial consolidation sell side liquidity, along with that our projected terminus to that higher time frame point of interest, and that will complete the market maker sell model's sell side of the curve. Now the information that you guys need to keep in mind, that a distribution circle or the sell side of the curve, that will always do the four things. It will run liquidity in the form of market structure shift here and in the form of this sell side liquidity. It will rebalance or run stops. It will rebalance the imbalance around that area, or it will run that short-term inducements or short-term liquidities below that imbalance or below that area. It will mitigate. It will mitigate for the first stage. It will mitigate inside of that breaker block. For the second stage, it will mitigate inside of the distribution block, and then it will continue from the first stage. It will continue for the second stage of the sell side liquidity, and from the second stage it will continue to our higher time frame point of interest and the below the initial consolidation low. So with these four informations, you can improve your trading quality if the other informations are for now going above your head. I hope with enough practice and enough dedication you can look into that, and the future lessons, a lot will be cleared step by step. As I said, first you go through these videos, write your questions, and try to figure out that by the end of the total series, how many of your questions has been answered and how many doubts you still have left over on that question paper or the question that you have organized or collected throughout the time. If it's not answered, you know where to find me. I will always be there to answer as long as I'm alive. So with that hope, I am going to sign off right now, and until next time, take a very good care of yourself, your health, and your loved ones. Bye bye.